Today we are talking about something that has the entire financial world on edge right now. Silver just did something today that most people thought was impossible, and if you are not paying attention, you are going to miss one of the most explosive setups we have seen in years. So stay locked in, because what I am about to break down could change the way you look at precious metals forever. OG John AG here. Before we dive in, this is not financial advice. Trading silver or any assets carries substantial risk of loss. Do your own research and consult a professional if needed. Let's start with the raw numbers, because they are absolutely jaw-dropping. Today on the COMEX, silver futures for the March 2026 contract, ticker SIH6, just ripped to $84.57 per troy ounce. That is a single-day gain of nearly $7, up 8.93% in one session, one day. The market opened at $78.47, crashed to a low of $77.28, and then absolutely launched to a high of $84.64. Volume came in at 55,397 contracts. That is not retail noise. That is institutional conviction. That is smart money moving with urgency, and you need to ask yourself why. Now, before I go deeper, if you are new here and you want real-time market breakdowns like this, make sure to press like button, hit that subscribe button right now, and ring the bell so you never miss an alert like this one. This channel is your edge in the market. So, let me give you the full picture, because this move did not happen in a vacuum. There are three massive forces colliding right now, and together they are creating what analysts are calling a once-in-a-generation setup in silver. First, the physical supply situation on COMEX is critical. Registered silver inventories are sitting at approximately 102 million ounces, and they are falling fast. Here is the shocking part that most people are not talking about. The March to May contract roll is happening at a pace of 30 million ounces per day. 30 million. Investment specialist Karl Merks has gone on record saying, and I want you to really hear this, at that pace, COMEX is out of silver by February 27th. That is 6 days away. And from April onward, the market faces a genuine physical shortage unless significant new inflows arrive immediately. This is not speculation. This is math. Second, the futures curve is breaking down in a way that is sending alarm bells through the trading community. When you adjust for financing costs like SOFR, the secured overnight financing rate, and storage costs, the March-May spread is approaching backwardation. Now let me explain why this matters, because this is where it gets really serious. In a normal market, futures trade at a premium to spot prices because of carrying costs. When that flips, when the spot price is worth more than future delivery, it means the market is screaming that physical silver right now is more valuable than silver delivered months from now. That is a shortage signal. And historically, when backwardation has exceeded $2, it has ignited rallies toward triple digits. We are getting dangerously close to that point. Former COMEX floor market maker Vince Lanci put it best when he said silver is a physical market that has outgrown its futures market. The futures market simply is not handling the physical demand anymore. And China, which accounts for 25 to 30% of global silver demand and is heavily dependent on silver for solar panels, is scrambling for supply right now. Third, and this one absolutely floored me, Binance just launched gold and silver perpetual futures contracts, and within weeks those contracts crossed $70 billion in trading volume. $70 billion. This is crypto-native access to silver running 24 hours a day, 7 days a week. This is a completely new class of trader entering the silver market at a speed and scale traditional markets have never seen before. And here is where it gets even more interesting. CME Group, the exchange that runs COMEX, has announced that beginning May 29th, crypto futures and options will also trade 24 hours a day, 7 days a week on CME Globex pending regulatory approval. CME recorded $3 trillion in notional crypto volume in 2025 alone, and year-to-date in 2026, average daily volume is already up 46% year-over-year. The old rules of market hours are being rewritten in real time. Now let me tie this all together with the technical picture, because the chart is telling a very specific story. Silver has been holding a major range between $70 and $84, and today we are testing the upper boundary. The RSI has been recovering from below neutral territory, and the critical level everyone needs to watch is 81.65, which is where the 50-day moving average sits. Today's action broke above that level. If silver can close above it and hold on the Monday open, the technical outlook shifts dramatically, breaking and closing above 84 points to a very high probability retest of $100. And I want you to think about what that means. Silver going to $100 from current levels is still a significant move from here. Resistance levels to watch right now are 81.65, which is the 50-day moving average, then the 82 to 84 zone, which is the 2025 record resistance, then 87.76, which is the 4-hour 200 moving average, then 90 to 95 is major higher time frame resistance, and then the big psychological target of $100 to $104. On the support side, the key momentum pivot is 76 to 77.50, major 2026 range support is 70 to 72, and if things really break down, December FOMC support sits at 60 to 64. But here is the broader macro picture, that makes all of this even more urgent. Gold's 30-day volatility just hit its highest level since 2008. 2008, when the entire global financial system was on the edge of collapse. That kind of volatility in gold always spills into silver, and silver tends to amplify it due to its dual role as both an industrial metal and a monetary asset. Meanwhile, geopolitical tensions involving the United States and Iran are pushing safe haven demand into overdrive, and a Supreme Court ruling impacting tariffs has weakened the US dollar, which is rocket fuel for dollar-denominated commodities like silver. And here is a number that should wake you up. In the crypto-linked silver futures markets, 129,117 traders were liquidated in a single day, with total losses reaching $543.9 million. Silver actually overtook Bitcoin in liquidations during that reversal event. Think about that for a second. Silver overtook Bitcoin in crypto liquidations. That tells you how interconnected these markets have become and how violent the moves can get in both directions. So, what does all of this mean for you right now? If you believe the inventory data, if you believe the backwardation signal, if you believe China's solar demand is structural and not going away, then the setup here is genuinely compelling. Lease rates for silver have spiked to 7.3%, the highest in over a decade. That is another stress signal confirming what the inventory data is showing. The physical market is tight and getting tighter, but OG John AG is always going to keep it real with you. Silver is notorious for violent reversals. We have seen 35% plunges in short periods of time. If geopolitical tensions ease, if the dollar strengthens, if new physical inflows arrive on COMEX in the next 6 days and reset expectations, this move can unwind fast. So if you are trading this, position sizing is everything. Monitor the March-May spread daily, watch the inventory updates from COMEX, and keep a very close eye on what happens at the Monday open, because today's close and Monday's reaction will determine whether this breakout is real or a head fake. The bottom line is this. Silver is showing all the signs of a market that is structurally broken on the supply side, while being overwhelmed by demand on multiple fronts at once. Traditional futures markets, crypto perpetuals, industrial users, safe haven buyers, all competing for a shrinking pool of physical metal. When that kind of pressure builds, the release can be extraordinary. Let's break down silver backwardation in a clear, no BS way, building on what we've been seeing in the market right now, February 21st, 2026. This isn't just some obscure trading term. It's one of the loudest alarm bells the silver market can ring, and it's flashing hard in the current setup. In a normal commodity market, like most of the time for silver, you see contango. That's when futures prices for later delivery months are higher than the current spot price or near-term contracts. Why? Because holding physical silver costs money, storage fees, insurance, financing, like the SOFR rate right now, and the opportunity cost of tying up capital. So the curve slopes upward. Future silver is supposed to cost more to account for those carrying costs. Think of it as paying a premium for convenience of not having to store the metal yourself today. Backwardation flips that entire logic on its head. It's when the spot price, or near-term futures, trades higher than prices for deferred delivery months. The futures curve inverts nearby contracts are more expensive than farther out ones. In simple terms, the market is screaming, I want physical silver right now, not in a few months. I'll pay extra for it today. Why does this happen? It's almost always a sign of acute physical tightness or urgent immediate demand overwhelming available supply. Buyers, industrial users, investors, or even central bank/strategic buyers are desperate for metal in hand immediately rather than a paper promise later. They bid up spot/near-term prices aggressively, while longer-dated contracts stay lower because the market expects the shortage to ease eventually or hopes it will. This creates a negative carry, instead of earning a roll yield by holding futures in contango. Longs in backwardation actually get positive roll yield as prices converge higher toward spot as expiration nears. In silver specifically, backwardation is rare and powerful because silver has that dual demand, 50-60% industrial, solar panels, electronics, EVs, AI-related stuff exploding right now, plus investment/haven flows during uncertainty. When both hit hard like China's massive solar buildup, geopolitical tensions, weaker USD, and now crypto/24/7 derivatives pulling in endless speculative money, the physical market can snap. Right now in early 2026, the COMEX futures curve isn't in full nominal backwardation across the board. For example, March 2026, SIH6 last around $84.57, with later months like April-May not massively below, but carry adjusted, factoring in SOFR financing plus storage costs. The March-May spread is approaching backwardation, or flirting with it. That's the key signal. Adjusted for real-world costs, immediate physical silver is already more valuable than future delivery. Lease rates cost to borrow physical silver have spiked to levels like 7.3%, highest in over a decade in recent reports, another red flag of borrowing pressure. We've seen deeper backwardation episodes in late 2025, gaps up to $2.88 plus in some spreads, deepest since the 1980s Hunt Brothers era, and the current tightness. COMEX registered inventories tilde 102 MOs declining fast, 30 MOs day roll pace potentially draining open interest by late Feb, keeps pushing toward it again. Shanghai futures have shown backwardation too, with spot premiums over London hitting record highs like $8 plus in late 2025, showing global physical stress. What does backwardation really mean for prices and the market? Bullish rocket fuel. Historically, silver backwardation precedes big rallies. It happened before the 2011 spike to tilde $50, the 2020 COVID surge plus 40% in 60 days, and late 2025 moves toward triple digits in some forecasts. Why? It discourages hoarding/storage. Why store if future is cheaper? And forces shorts to cover or deliver physical, which tightens supply further. If backwardation deepens, say 15 to 25% annualized or severe gaps, it can ignite short squeezes, cascading buys, and explosive upside. Some analysts eye $90 plus, $100 plus, even $200 plus long-term in extreme scenarios. Short squeeze risk? Shorts in futures can't easily roll if backwardation persists near expiration like March 2026. Refusals to roll contracts? Already whispers. If delivery demands spike, it exposes the paper-physical disconnect. COMEX has way more open interest than registered metal, so failure to deliver could force massive covering. Volatility amplifier. Backwardation signals scarcity, so any news, China demand post-Lunar New Year, inflows, outflows, geopolitics, hits harder. But it cuts both ways. If supply floods in or demand cools, the curve can flip back fast, leading to sharp corrections like recent plunges we've seen. Physical versus paper warning. As Vince Lancy and others say, silver's physical market has outgrown its future/paper system. Backwardation is the market admitting that owning real bars, coins right now beats any ETF, future, or tokenized version during these phases. Bottom line, backwardation isn't just technical jargon. It's the market yelling that physical silver is scarcer and more urgently needed than the paper promises suggest. In the current 2026 environment, with inventories draining, industrial demand roaring, safe haven buying, and 24/7s, crypto derivatives, adding non-stop pressure, it's a high-conviction bullish signal near-term, but with huge volatility risks. Watch those March-May spreads, lease rates, and COMEX inventory reports like a hawk. If we go full carry-adjusted backwardation and hold it, expect fireworks. Silver backwardation is a rare and powerful signal in the precious metals world, and history shows it often precedes explosive price action, though not always without wild swings or corrections afterward. Here are the most notable historical examples of silver entering backwardation, or deep/carry-adjusted backwardation, pulled from market records, analyst reports, and key events. These episodes highlight how physical tightness, speculative frenzy, or supply shocks flip the futures curve and drive massive rallies. 1. The Hunt Brothers era, late 1979, early 1980. This is the classic, most extreme case of silver backwardation in modern history. The billionaire Hunt brothers, Nelson Bunker, William Herbert, and Lamar, aggressively accumulated physical silver and futures contracts, attempting to corner the market amid inflation fears and distrust of paper currency. Backwardation details. Deep and persistent inversion, with spot prices soaring far above futures as delivery demands overwhelmed supply. Gaps exceeded $2 in some spreads, a record at the time, forcing buyers to pay massive premiums for immediate metal. Price impact. Silver rocketed from around $6 $10/Oz in mid-1979 to an all-time high of nearly $50/Oz, intraday tilde $50.35 on COMEX, by January 18, 1980, a staggering 700% plus surge in under a year. Backwardation fueled the frenzy, as shorts scrambled and physical hoarding intensified. Outcome: the rally peaked, then crashed dramatically on Silver Thursday, March 27, 1980, plunging over 50% in days to tilde $10.80 per ounce amid margin calls, regulatory crackdowns, for example, COMEX rule changes limiting positions, and forced liquidations. The Hunts faced bankruptcy threats, fines, and trading bans. Why it mattered. Backwardation here was driven by manipulation/speculation plus real physical cornering, creating one of the biggest commodity squeezes ever. It set the benchmark for how severe inversions can ignite parabolic moves. 2. Early 2011, February-April 2011. Silver entered notable backwardation as investor demand exploded post-financial crisis, fueled by QE, inflation worries, and ETF inflows. For example, SLV booming. Physical shortages emerged, with dealers reporting delivery delays and premiums spiking. Backwardation details. Futures curve inverted, with near-term contracts, for example, March/May, trading at premiums over deferred months. It was the first significant backwardation in over a decade since late 1990s minor episodes, tied to tight physical supply and producer hedging. Price impact. Silver surged from $18.26 $18.26/Oz in late 2010 to an intraday high of $49.82 per ounce on April 28, 2011, nearly doubling in months. Backwardation acted as rocket fuel, squeezing shorts and amplifying momentum. Outcome: the peak led to a sharp correction, down to $1.26 by year-end, blamed on over-leverage, margin hikes, and profit-taking. But the run was one of silver's strongest bull phases in decades. Why it mattered. Unlike 1980s manipulation, this was more organic from investment flows plus lingering crisis fears, showing backwardation as a bullish precursor even without a corner. 3. March 2020, COVID-19 supply shock. During the early pandemic chaos, global lockdowns disrupted mining/refining/logistics, while safe haven buying spiked. Backwardation details. Brief but sharp inversion as physical delivery demands clashed with paper market dislocations. Spot premiums over futures emerged amid fears of shortages. Price impact. Silver bottomed around $11.12/Oz in March 2020, then tripled to $1.30 by August, a 150% plus rally in months. Backwardation signaled the turning point from crash to recovery. Outcome: prices stabilized higher, but volatility remained high into 2021. Why it mattered. This showed backwardation during a crisis-driven supply crunch, industrial plus investment demand colliding, proving it's not just speculative, real-world disruptions trigger it. Other notable/shorter episodes: September 2015, minor backwardation during a low-price environment, $1.14/Oz, preceding a climb to $1.21 by mid-2016. Late 2008, financial crisis, brief backwardation as investors fled to physical assets amid bank failures. 2025 episodes, multiple. Deep backwardation returned big time, e.g., October 2025, saw record spreads up to $2.88, deepest since 1980, with lease rates spiking to 39% annualized. Spot exceeded futures significantly, tied to industrial tightness, solar electronics, ETFs derivatives flows, and physical squeezes. This fueled rallies pushing silver past previous highs, for example, toward $60 plus in some reports, with ongoing inversions into 2026 signaling persistent scarcity. Across these cases, backwardation almost always flags urgent physical demand outstripping supply, leading to rallies of 5,700% in short periods, but it's volatile. Sharp corrections often follow peaks due to over-leverage or external shocks, regulations, macro shifts. In the current 2026 setup, with carry-adjusted backwardation approaching amid draining COMEX stocks, history suggests watching for continuation. If physical inflows don't materialize, could mean more upside fireworks, but brace for turbulence. This is OG John AG, and I will be watching every move in this market so you do not have to. If you found this breakdown valuable, smash that like button, drop your thoughts in the comments below, and subscribe if you have not already, because the next few weeks in silver could be some of the most important we have ever seen. Stay sharp, stay ahead, and I will see you in the next one.